So now let's continue. Let's do financial reporting, broke revision. And I want us to start on insurance, accounting for insurance. So just a quick recap, that insurance company, that their major sources of income are the premiums. Those are their major source of income. And their major expenses, or the major expense, are the claims. Good. So now with that, so let's do a question. Take out your handout page 39. Handout page 39. Yeah, there is a revision question there under the topic of insurance. So when we're accounting for insurance, number one, you need to prepare the revenue account. And the revenue account is used to determine whether they operated at a profit or loss. So let me draw the format for revenue account. So there is fire, there is marine. Fire, marine. So we say that when presenting the revenue account, for the insurance, we just need to remember the format. So how do we prepare the revenue account? So on the credit side, we bring the incomes, and for the incomes, we had premiums. So you take premium received, then we say that you add premium receivable balance carried down, but you raise premium receivable balance brought down. You add the one at the end, you deduct the one at the beginning. Then you add reinsurance premium received. Reinsurance premium received, but you deduct reinsurance premiums paid. And that's how you get the net premium. Once you get the net premium, you bring other incomes, and other incomes include commission ceded. Remember, we said that commission ceded is an income, but commission accepted is an expense, and any other income. Then on the debit side, you bring the expenses, and the major expense is the claims. So how do we get the net claims? So you take claims paid, you add claims balance carried down, but you raise claims balance brought down. Also, you raise claims covered by reinsurance. And then once you deduct that, you can also add claims expenses. Claims expenses. And that's how you get the net claims. Now, once you get the net claims, now you can add other specific expenses, such as commission accepted. We have commission accepted. Also, in case there is auditor's fee, management fee. Based on the information provided. So now let's go through that question. Let's go through that question. We are told that the following trial balance was extracted from the book of Bima Insurance Company Limited as at that 1st December 2016. So we have the premium outstanding. Those are the premium balance brought down. So I'll be reading then adjusting. And we say that at the premium, you raise premium balance brought down, and we had 320, and the other one we had 480. Then we had government security, that's an asset, building, motor vehicles, furnitures, claims paid. Now, claims paid is an expense, and claims paid goes to the revenue account. For the fire, they paid that 680, and then there was 4120 for marine. Then we have premium received. So premium received, you credit the revenue account, and the premium received, we had 5,400. Then we also had 6,200. Then we have reinsurance premium received. Also, that one we add to the premium account. We say that you add reinsurance premium received. So for the insurance premium received, we received 840, and we had 1120. Reinsurance premium paid. So that one you deduct it. We paid a premium. For fire, we paid 720, and then for marine, we paid 980. Then we have reinsurance, we have bank and cash balance, that's an asset. Direct commission paid. Commission is an expense, and in this case, they are specific. So you say that you bring all the expenses here. So you bring commission paid, and direct commission paid, we have 270, and then we have 360. Management expenses, that's a specific expense. Management expenses, we have an amount of 1340. Then we have 1420. And earned premium reserve. So we say that an earned premium reserve you credit on the revenue account. So you bring an earned reserve, premium reserves, balance brought down. You credit, and then you credit reserves balance carried down. So an earned premium reserves balance carried down. So we say that you debit the you credit the balance brought down, you credit the balance carried down. And you're told that the unearned premium reserve on 1st January 2016, those are the opening balances. So we had that 450. The other one we had 4,800. Then we have additional premium reserve. So it's another reserve opening balance. So additional reserve. So we have an amount of 680. And then we have 960. Then we have claims outstanding 1st January 2016. Now those are the claims balance brought down. We say that under the claims, you raise claims balance brought down, and the claims outstanding we had 230, and then we have 340. Then we also have ordinary share capital, share premium, revaluation reserve, revenue reserve. Audit fees is an expense, but it's not a specific expense. Directors' remuneration, depreciation, sundry creditors. We have investment income, amount due from other insurance companies. That one is an asset. Reinsurance claims received. So we said here that you raise claims covered by reinsurance. So and you are given in that case, reinsurance claims received. So we had 480. That one you deduct from the claims. And then we also have 750. Deduct from marine. Then amount due to other insurance company, that's a liability, it's more for payables. And then we have general expenses. So general expenses goes to the general income statement. Additional information. On that 1st December 2016, interest on an investment receivable amounting to 40 had not been accounted for in the books. Number 2, claims outstanding are not accounted for in the books as at that 1st December 2016 was follows. Now, those are the claims outstanding by the end of the year. We said that under our revenue account, you take claims paid, you add claims balance carried down. And we have 11, and we have 230. Then number 3, I told that premiums for the year ended that 1st December 2016, not yet received, was shown below. So now those are the premium balance carried down, and the premium balance carried down, we have an amount of 180, and we have 320. We said you add them. Then you do that. Out of the claims outstanding on that 1st December 2016 for fire insurance, an amount of 35 million was recovered by reinsurance. So out of the claims outstanding, So here where you have the claims covered or insurance, you need to add, because we're talking about out of the claims outstanding on that 1st December 2016 for fire insurance, an amount of that 5 million was recovered by the insurance company. So amount covered by the insurance, you add 35 here. And then you take it to the part of current assets, is what you expect to receive. Then number 5, commission for insurance ceded and accepted had not been accounted for and should be provided at 5%. So that's the commission ceded and commission accepted. It's at the rate of 5%. We said that, let me take you back to the definition, that commission ceded is an income which is computed based on the proportion of reinsurance premium paid. So you'll take 5% of the reinsurance premium paid, and reinsurance premium paid for fire was 720 and the other one was 980. So we get 5% of that. So here we have 0.34, sorry. We have 0.05 of 720. This is 36. 98 divided by 2. And here you have 49. Then also for the commission accepted, you take 5%. Commission accepted is an expense based on the proportion of reinsurance premium received. So you take reinsurance premium received. For fire was 840 and for marine was 1120. So here you get 42. And this one you get 56. That was number 5. Let's go to number 6. Tax on the trading results for the year ended that 1st December 2016 should be provided at 235 million. Then number 7, an earned premium reserve is maintained at 50% of the net written premium for the fire insurance and 100% of the net written premium for marine insurance. Then number 8, additional. So with that, before we get the unearned premium, first of all, let's get the net premiums and the net claims. So we get the net premium and net claims. So I have 6180. Here we have 5380. So those are the net premiums. So let's get the net claims. For the net claims, we have 3680. You add 110. You deduct 230. There you have 3045. You have that 260. So now we need to provide an unearned premium balance carried down. So let's go back to note number 7. And that's what we are told number 7. Number 7, you're told that an earned premium reserve is maintained at 50% of the net written premium for fire insurance and 100% of the net written premium for marine. So for an earned premium balance carried down, we are told that for fire, we maintain 50% of the net premium. And net premium, we had 5380. We maintain 50%. So that's 5380. We divide by 2. So that means the balance carried down will be an amount of 2690. But you're told that for marine, we maintain 100%. So it will be 6180. 6180. Number 8, additional and unearned reserve. So also we have additional reserves. Additional reserves, balance carried down. So you're told that number 8, additional and unearned reserve is maintained at 10% of the net premium for fire insurance and 15% of the net premium for marine. So for fire, we maintain 10%. So you take 10% of the net premium, which was 5380. So 10% is 538. And then for marine, you maintain 15%. So you take 15% of 6180. You get 927. So now with that, we want to determine whether they operated at a profit or a loss. So let's now balance that. Now the balancing figure, if it's on the debit side, that means they operated at a profit. If you get it on the credit side, that means they operated at a loss. So we have 11,989. So this one, I'm getting a loss, 214. The balancing figure is on the credit. Then for fire, so I have 9546. $26.90. And here I have a profit of 16.21. So let's go to the required. Number A was revenue account for the year ended that 1st December 2016. Now that's how you're supposed to present your revenue account. Number B, general income statement. So let's present the general income statement. So, and the name of company, this is Bima Insurance. Bima Insurance Company or Limited, present income statement for the year ended that 1st of December 2016. So our shillings are in thousands, so are in millions. So to the general income statement, we start with the revenue. And the revenue you get from the revenue account. We had the revenue from fire, and then we have for marine. And the revenue from fire, that was the profit. The profit you got from the fire was 1621. Then for marine, we had a loss of 214. So you'll bring 214, but as a negative. Then I saw there was investment income. Let's go back to the top balance. How much was the investment income? And we had an investment income of 1740. Then you add, let's go to note number 1. On that 1st December 2016, interest on investment receivable amounting to 40 had not been accounted for in the book. So we had another investment income of 40. We had not accounted for it. So the total investment income should be 1780. Then we deduct the expenses. And for the expenses, you only deduct the general expenses, the expenses which were not captured in the revenue account. So for the first expense I can see there was audit fees. Audit fees. The audit fees was an amount of 640. Then, apart from the audit fees, we have directors' remuneration. Directors' remuneration, an amount of 1240. Then we have depreciation. And for depreciation was an amount of 420. And then we also have general expenses. And general expenses we have is 180. I don't think we have any other expense. So we get our profit before tax. So how much is our profit before taxation? Here I'm getting 707. Then we raise the tax expense so that you get profit after tax. So how much was the tax expense? Let's go to additional information number 6. Additional information number 6, we're told that tax on the trading results for the year ended that 1st December 2016 should be provided at 235. So you raise 235, and that's how you get the profit after tax. You get 472. 472. So that's how you're presenting the income statement. So now with that, you can take a screenshot. Take a screenshot before I rub it. So let's present now the balance sheet. So allow me to erase this. Now we present the balance sheet. Bima Insurance Limited. We are presenting statement of financial position as at that 1st December 2016. So we start with the assets, non-current assets. So what do you have to the non-current assets? Actually, the balance sheet is always a free month because we just need to get 6 correct entries. So I can see we have buildings. Our shillings are in millions. And buildings, we have 10,300. Then above it, we have government security. Yeah, those are the bonds. It's non-current assets, 8630. Then we have motor vehicles. For motor vehicles, we have it's 5750. Then we have furnitures. For the furnitures, we have 1340. I don't think we have any other. We didn't have any other. So now let's go to the current assets. So to the current assets, number 1, we have bank and cash balance. For the cash and bank balance, we have 910. Then we also have, do we have any receivables? Yes. We have account receivables. Or don't we have? So before the additional information, there is amount due from other insurance company. That's a receivable. Amount due from other. So it's a receivable. Amount due from other insurance companies, 2,500. But amount due to becomes a liability. Then, still under current assets, we have another income. Remember, premium we said is an income, but we have premium we have not yet received by the end of the year. So premiums receivable, you take the balance carried down. So let's go to note number 3. Number 3, you are told that for the premium for the year ended that 1st December 2016, not yet received was as follows. So that means it becomes amount receivable. So you take 180 plus 320, and that's 500. Then we also have an amount we accounted for it, but we never showed in the balance sheet. We have commission seeded. We say that commission seeded is an income, but we told that we are to provide it at 5%. So that 5% we accounted for it, but we never received. So how much was the amount? How much was the amount? So since I don't have the answer, but I have the screenshot, we had that 6 and 49, that 6 and 49, 40, 50, 60, 70, that's 85. We have 85. Then we have another amount receivable. Let's go to additional information number 1. On that 1st December 2016, interest on investment receivable amounting to 40 had not been received. So we have investment income receivable, an amount of 40. So what else do we have? So we'll come back to that. So now let's go to the equity and liabilities. To the equity and liabilities, so we have ordinary share capital. That's another free mark. And for the ordinary share capital, what do we have? We had 8,000. Then we also have share premium. And the share premium, we have an amount of 4,000. Then we have revenue reserve. Those are the retained earnings. And revenue reserves. And for the revenue reserves, we have an amount of that 550. And then you add the profit after tax. The profit after tax from the income statement was 472. Then I don't think we paid any dividends. We never paid any dividends. So you'll take that 550, you add 472. You have 4022. What else do we have? So apart from that, we have other reserves. So we have an earned premium reserves. Also, we had additional premium reserves. Now, from the revenue account, let's go back to the revenue account. In the revenue account, we had the unearned premium reserves at the end. Now, those reserves, that's the money set aside, becomes part of equity because it's a reserve. Yeah, cutters of note number 7. Go through note number 7. And then how much was the amount? So for an unearned premium reserve, so we had 2690. And the other one, we had 6180. Then you also have additional reserves. For additional reserves, we had an amount of 538. And the other one, we had 927. So those becomes or forms part of non-current, part of equity. So 2690, you add 6180, and we have 8870. 538 plus 927, have an amount of 1465. Good. So let's go to the non-current liabilities. Do we have any non-current liabilities? No, I didn't see any loan. So that means we just go to the current liabilities. So what do we have to the current liabilities? So to the current liabilities, I can say we have amount due to other insurance companies, amount due to other insurance companies, an amount of 1120. Then we have sundry creditors, and for the sundry creditors, we have an amount of 360. Then we have, remember we said that claims are expenses, but we have expenses. That means we have premium we have not yet paid by the end of the year. That is courtesy of note number 2. Number 2, you're told that claims outstanding are not accounted for in the books by the end of the year. So we have claims payable. And for 5, we have not paid, yet paid 110 and then 230. So that is 340. Then we have commission accepted. We say that commission accepted is an expense, is a commission payable to other insurance company. But we accounted for it, but we have not paid for it. But we have to provide it at 5%, and we provided. So when we provided, how much was the rate? So you go to the revenue account, and we had 42, and the other one was 56, and you get 98. Any other liability? Yes, we have the current tax. We provided current tax. That's additional information number 6. Tax on the trading result for the year ended 31st December should be provided at 235. That means we have not paid, but we have provided for it, which is 235. With that, I don't think we have any other liability. Good. So let's try to balance that. So here I'm having 25, 28, 510. Then I'm minus 10, 300, 630, 750, 1340, 910, 500, 500, 85, 40. So there is something we have not yet indicated. We had amount covered by reinsurance. So can we go back to note number, note number 4. Out of the claims outstanding on that 1st December 2016 for insurance, for fire insurance, an amount of 35 million was recovered by reinsurance. So you have amount recovered by insurance. We expect to receive it. Yeah, receivable on reinsurance. And that you have an amount of 35. So what else have we not yet included? So premium, so we have that cash, direct commission paid, management. We also had revaluation reserve. We have not captured that. Revaluation reserve. And how much was the revaluation reserve? We had a revaluation reserve for 4,000. So how much was the share premium? Sorry. Actually, here we missed. Share premium was supposed to be 4,000. Then revaluation reserve was that 550. That means our revenue reserve is wrong. So, and the revenue reserve or the retained earnings was an amount of 1,580. So it's 1,580. Then you add, so 1,580, you add 472, you have an amount of 2052. So I think that's okay now. So yeah, it's okay now. It's 30,090. 30,090. So you can take a screenshot of that before I rub it. Good. So that's how you present that. So the most important thing, it's all about know how to present the revenue account when accounting for insurance. Once you know how to account for the revenue account, the income statement and the balance sheet, those one has not that much problem, because the balance sheet is all about knowing what are the assets, what are the liability. And in case you forget some, you can get all the marks. But for the revenue account, it's very sensitive. So with that, I want to give you an assignment. Go and try this question. There was this question. Yeah, December 2010. December 2010, question 2. December 2010, question 2. Also, you can open that question. Let me just show you on how to present the revenue account. Then you can prepare the income statement and the balance sheet. So I just want to show you how to prepare the revenue account. So when presenting that statement, even before you read the question, just know the format. What do we take on the debit side? What do we take to the credit side? So let me start with the incomes on the credit side. We say that you take premiums paid, premiums received, premium received, then you add premiums balance carried down, then you raise premium balance brought down. Then you add reinsurance premium received, but you deduct reinsurance premium paid. And that's how you get your net premium. Once you get your net premium, you bring other incomes such as commission, seeded, and also you factor in the unearned or unexpired premium reserve balance brought down. So it's called unearned or unexpired risk premium. Unexpired, unearned premium balance brought down. Then on the debit side, you bring your expenses, and the major expenses are the claims. So you bring claims paid, then you add claims balance carried down, but you deduct claims balance brought down. Also, you deduct claims recovered or received, recovered on reinsurance. Yeah, those are the claims you are supposed to pay, but the other insurance company, they helped you on paying that. And then you add any claim expense, such as legal expenses or the severe expenses. And that's how you get your net claims. Once you get the net claims, you add other expenses which are specific, such as commission accepted. And you say that commission accepted is an expense. Yeah, that's the commission paid to other insurance company. but commission received is an income. These are commission received from other insurance companies. Good. And then also, if you have your unearned premium balance go down on that side, so unearned premium reserves, balance carried down goes on the debit side. So in this case, you are comparing between the reserves at the beginning, reserves at the end. Now, increase in reserves becomes an expense. Decrease in reserves becomes an income. So now let's go through that question. Go through that question. So, and we are told that the following 12 balance was extracted from the book of Umoja Insurance Company Limited as at that 1st October 2010. Ordinary share capital of shillings 10, retained profits, revenue, reserves for unexpired risk. So reserve for unexpired risk, those are the unearned premium balance go down. So let's just indicate that amount directly. And the amount was for fire was 320,000. And for marine was 16,000. Then we have treasury bills, government loan stock, Kengen bonds. Those are the assets. Equity investment is still an asset. Premium received, that goes to the revenue account. And for the premium received for fire was 1327,500. And for marine was 853,800. Then we have premiums paid for the premium paid. So now that's the insurance premium paid. That one we say that you deduct. We had 250,500. And also we have 147,400. Then we have additional reserves. So those are the additional reserves balance brought down. So additional reserves, and for additional reserves, you had an amount of 357. And the other one was 37,500. Then we have furnitures and fittings, account receivable, bank balance, cash in hand, outstanding claims. Those are the claims balance brought down. And we say that you raise claims balance brought down. We had an amount of 9,000, 1,000. Then we have investment income, account payable, investment fluctuation reserves. So that one goes to the part of equity, it's a reserve. Management expenses, they are specific. So you bring it here. Management expense, they are part of expenses and they are specific. So we have 196,000 and you have 83. Then we have claims paid. Claims paid is an expense. So you bring it here. 288,000. And you also have 260,500. Then we have commission paid. That one is part of expenses. And commission paid was an amount of 174,000. And then we have 123,500. Audit fees, that one you take it to the general income statement. That one they are not specific. Contribution to staff provident fund, that one is an expense. Outstanding premiums, those are the premium balance brought down. And we say that you raise premium balance brought down. So 352,000, you deduct that. And also we have an amount of 298,000. Additional information. As at that 1st December 2010, various balance sheets relating, various balances relating to the fire and marine insurance were provided as follows. So number one, we have claims recovered on reinsurance. Now for the claims recovered on reinsurance, we see that you raise claims recovered on reinsurance. So we have 45,000 and then we had 20,000. That one you deduct. Then we have outstanding premium. Those are the premium outstanding by the end of the year. That's what you call premium balance carried down. So we have 280. and we have 375, 600. Then we have claims due, and also we have claims intimated. So both claims due, that's what we have not paid at the end of the year. And then we have claims intimated. They are the claims we never accounted for them. So if you want to get the claims balance at the end, you just add the two. For example, for fire, the claims due was 10 and the one intimated was 8. So that means by the end of the year, the total was 18. So we say that you add claims balance carried down. So you add 18. Then for marine is 25. And then you add 20 and you have 45. Both of them, they are due. The one intimated, that means they didn't account for it. The other one due is what they accounted for it, but they have not paid. Then we have commission owing on reinsurance accepted. So that one you are given. Commission accepted. This is 45, and the other one is 25. Provision to be made on sundry expense. Those are provision for sundry expense. Sundry expense. Here we have 20,000. And the other one we have 60,000. And then, since this expense is a provision, that means they have not accounted for it. So you'll take it still under current liability, accrued expenses, because we made a provision, but that provision has not been accounted for. That's why it's not in the trial balance. So you take it still under part of current liability. Also, commission or insurance accepted. This expense of 45, we have accounted for it, but they have not already accounted for it. So I mean, they have not recognized it. So we have just made a provision here. Since in the additional information, also take it as part of current liability. Then number 2, commission on reinsurance ceded is allowed at 5%. So we say that commission ceded is an income, and it will take 5% of the reinsurance premium paid. And here, this was the insurance premium paid. So here we paid 250,500, and the other one was 147,400. You provide 5% on that. So that one will be 2,550 divided by 2. And here you'll get 12,525, 14,740 divided by 2. And here you have 7370. And then those commissions ceded, it's an income. We have accounted for it. Therefore, you take it as part of account receivable. That's part of current assets. It's an income, but we have not yet received it. So it goes to the part of current assets. Good. Number 3. Provision are to be made as follows. Number 1, additional reserve for an expired risk is to be increased by 5% and 3% of the net premium in respect of fire and marine. Depreciation on furniture and fittings at the rate of 10% per annum or reducing balance. So that one you take it to the general income statement. Taxation and ordinary dividend of 1%. Then before we go to number 4, first of all, let's get the net claims and the net premium. So here we have so here you have 1005. That's what we have. 853, 800. Here you have 784. So let's get for claims. This is 252, 260,500 plus 45. It's 21,000. You get 284,500. So now with that, with the net premiums and the net claims, now we can go to note number 4. Number 4, you're told that reserves for an expired risk should be 50% of the net premium in the case of fire insurance and 80% for fire insurance. Now, what we have got here as our net premium, so you take it to the reserves, and we have premium reserves balance carried down. So we are told that in respect of fire, we maintain 50%. So it's 1005, you divide by 2. So this one will be 502, 500. Then the other one is 784,000, you divide by 2, and you have 3. Sorry, this one was supposed to maintain at 80%. Sorry, this is 80%, not 50%. So therefore, it will be 784,000 times 0.8, and you have 627,200. Then there is an additional reserves. So let's go to the additional reserves. For additional reserves, let's go to note number 3. Note number 3. Number 3, we were told that the first bullet, additional reserve for unexpired risk are to be increased by 5% and 3% of the net premium. So now let's be here. You need to pay some attention here. So additional reserves, the opening balance, we have the opening balance. For example, for fire from the, it was 357. Then you add, we are told that it will be increased by 5% of the net premium, not of the reserves. If you are to provide, if the statement was, is to be increased by 5% of the reserves, would have taken 357 times 105%. But in this case, we are told that it's to be increased by 5% of the net premium. So you add 5% of the net premium. For fire, our net premium was 1005, like that. So that means you'll take 5% of 1005,000 and you get 50 to 50. So this is 50 to 50, and then you add 357, like that. So that means the reserves will be 407 to 50. Let's do now for marine. For marine, let's be here. The additional reserves balance carried down was 37,500. Was 37,500. Then we increased by 5% of the reserves. So you'll add 5% of the reserve of the net premium. Sorry, 784,000. So you take 78,400 divided by 2, you get that 9,200, you add 375, that's 7,500, like that. And this one you get, it will be 76,700. Now this is what you take as your balance carried down. 76,700. Then with that, now you can be able to determine your profit or loss. So remember, this was you are supposed to do it as an assignment. I just decided to show you on how to present the revenue account. Then once you present the revenue account, income statement and the balance sheet, for them, they are straightforward. Good, so you can take a screenshot of that. So good. So now with that, let's do now another topic. So now let's look at construction contracts, long-term construction contracts. Under IAS 11. And we said there are contracts which takes more than one accounting period before their completion. And we say that we have various types of construction contracts. One, we have what we call the fixed price contract. Just a reminder. And then we said we have a cost plus contract. And fixed price contract was the same as the lump sum contract. And cost plus contract, they are the same as the percentage rate. Yeah, percentage rate contract. What was the difference? So I'm guessing you have the notes. It's not guessing, I know you have them. So for the fixed price contract, they are contract whose price is determined before the inception. Before you start the contract, you agree in advance. Then we have cost plus contract. They are contract whose price can only be determined upon completion of the contract. And why is that? Why is that? This is because it's applied mostly when it's difficult to estimate the contract cost. Then we say that we have two methods used to account for construction contracts. One was the completed contract method, completed contract method. And number two, we had the percentage of completion method, percentage of completion method. And they say that under completed contract method, this is where the profit or the revenue can only be determined upon the contract being completed. But under percentage of completion method, this is where the revenue, the cost, and also the profit can be determined as the contract progresses. And in this case, how do we determine the percentage of completion? We say that the percentage of completion, you'll be taking cost to date, you divide by the total cost, then you multiply by 100%. And then with that, how do you determine the amount of revenue to recognize? So revenue recognized, we said you'll be taking percentage of completion, you multiply by the contract price. You multiply by the contract price. And then also we say that which method can you use to determine the percentage of completion? So we say that method used to determine the stage of completion. Stage of completion, they were two. Number one, we say that you can use what we call the value-based method. And number two, we had the cost-based method. Those were the two methods which can be used to determine the stage of completion. And we say that the value-based method, in this case, you take the value, and the value can conduct either a survey or the number of units. For example, if you're given a contract to produce 100 units, but by the end of the day, you have already produced 30, you just take what you have produced 30 over the total. So in that case, you are based on the value. That's what you call the units. If you decide to use the cost-based method, in this case, you determine how much was the expected cost. Assuming the expected cost was 10 million for you to complete the contract. But by the end of the year, you have only spent 5 million. So by the end of the year, you have spent 5 million, and you expected the project to spend, for the entire project to spend 10 million. So if you have spent half, so that means you can say that you are halfway project through. So that's another method you can use, value-based or the cost-based method. So that was just a recap. You already have them. So I want us to do a question from the past paper. There's a question I had given out in your card, and that's May 2014. Yeah, May 2014, question 2C. May 2014, question 2C. May 2014, question 2C. So let's start with question 2A. Part A of the question. In the context of IAS 14, agriculture, define the term biological assets. We say that a biological asset is a living animal and plant in an agricultural activity. So you're not writing, you have them in the notes. Number 2, explain the circumstances under which an entity should recognize a biological asset. We say that we have these circumstances you can use. Number 1, when the company controls the assets. Number 2, when the entity owns the assets. So that's when you control, then when you own, and then the value of that asset can be measured reliably. And number 4, when the company expects some future economic benefit from that asset. Those are the 4 circumstances in which an entity should recognize a biological asset. Not necessarily a biological asset. Actually, that's the criteria for you to recognize all the assets. Number 1, for the company to recognize any asset in their balance sheet. Number 1, it must own that asset. Number 2, it must control that asset. Number 3, the value of that asset can be measured reliably. And then number 4, you expect some future economic benefits. Those are the 4 circumstances. Good. Number B, part 1, define the term erroneous contract. We see that erroneous contract is a contract which, if you undertake that contract, you end up getting a loss. In short, is that the cost incurred in that project will exceed the amount of revenue expected to receive. That's what you call erroneous contract. Then number 2, differentiate between the fixed price contract and the cost plus contract. That's what I have just said here. Number C, Jing Limited is undertaking a project to construct a shopping mall, which commenced on 1st April 2013. The project was expected to take 3 years, so therefore it's a long-term construction contract, to complete at a fixed price of 600 million. The data of the cost incurred during the year ended that 1st March 2014 are as follows. So we have architectural and engineering design, site excavation cost, construction material, depreciation on site equipment, environmental impact assessment, site labor cost, and the total is 161. Now that's what we call the cost to date. Additional information, that was by the end of the 1st year. The contract was to take 3 years, but in this case, we are given the information about the 1st year. The estimated additional cost to complete the contract is 276 million. Architect certificate invoiced to date amounted to 155. Those are the billing or the invoices. The progress cash received to date was 140. Those are the down payments. The management is certain that the project will be completed on time. Required, estimate the percentage of completion of the contract. So to get the percentage of completion, so we say that you take cost to date. Then you add estimated additional cost. Estimated additional cost. So how much is the cost to date? Cost to date is 161. That's the total. Then I'm on to that. The estimated additional cost to complete the project. For you to complete the project, you expect to spend an additional 279. So how much do you expect? How much is the expected total cost? So in that case, our total cost will be 161. You add 279, and you have 440. So now let's compute the percentage of completion. And to get the percentage of completion, you take cost to date, you divide by the total cost. You multiply by 100%. And how much is the cost to date? Our cost to date is 161, and the total cost is 440. Then you multiply by 100%. So that means by the end of the 1st year, we were that 6.6% through. That's number 1. That's what you're supposed to do. Number 2, extract of the income statement. So let's present the income statement. So how do we get the income statement? So to the income statement, we have Jing Limited income statement extract for the year ended. For the year ended 31st of March 2014. And with respect to that, our shillings are in millions. So number 1, you need to identify the amount of revenue recognized. And I've shown you on how to get the revenue recognized. To get the revenue recognized, we take that. You take the percentage of completion. So by the end of the first year, we were at 6.6% through. But how much was the contract price? Yeah, the contract, the project was for 3 years and the completed, okay, and the fixed price was 600. If we have charged 600, and we are at the end of the first year, we are that 6.6 through. So that means we can recognize a revenue of that 6.6% of that 600. So 0.366, you multiply by 600, you get 219.6. Yeah, to get the revenue recognized, you take percentage of completion times the contract price. Then you raise cost to date. This revenue recognized to date, you raise the cost you have already incurred to date, which is 161, and that's how you get the gross profit. And the gross profit should be 58.6. So in this case was the first year. So you cannot deduct the gross profit already recognized because this was the first period. Number 3, extract of the statement of financial position. So number 3, Jing Limited statement of financial position as at that 1st of March 2014. So our shillings are in millions. So we say that the motive of preparing the balance sheet is to identify 2 items. One is the work in progress, and the other one is the amount of receivable or the payable. And how do we get the amount of work in progress? You take cost to date, you add gross profit to date, then you raise cash received to date. And that's how you get the amount of work in progress, which is part of current assets. Once you get the work in progress, another item we need to identify is the receivable or the payable. And how do we get that? So you take billings to date, billings or total invoices to date. You compare against URES, the amount of cash received to date. And the difference between the two will give you either the account receivable or the account payable. So how much is the cost to date? The cost to date was 161. You add gross profit to date, that's from the income statement, which is 58.6. Then you raise the cash received to date. So how much is the cash received to date? Let's go to note number 3. The progress cash received to date was 140. So what does that mean? So how much? So we'll take that plus 161, you divide by 140. So you have 79.6. So that's the amount of work in progress. Good. So that means it's the work which has started, but it has not yet been completed by the end of the year. Then we want to determine the amount of receivable. You take the billings or the invoices to date, and you are given in additional information number 2. Architect certificate invoice to date amounted to 155. So you had invoiced your client or the contractee 155. But how much did you receive? The cash received to date, you only received 140. You billed him 155, you only paid 140. So that means there's an account receivable of 50. Those are the data, the amount we expect to recover during the year. Good. So you can take a screenshot of that. So let's try another question. Open May 2019, question 4. May 2019, question 4. I hope now you are there. So let's start with part A. Distinguish between the following terminologies as used in construction contracts: lump sum contract and percentage rate contract. They say that lump sum contract is the same as fixed price contract, and percentage rate contract is the same as the cost plus contract. And I've explained that. Indemnity clause and retention clause, those one we did in insurance, we have those definitions. Then number B, discuss two methods of determining the stage of conclusion of a construction contract. We have said them. It's the value-based and the cost-based. Number C, Mijengo Construction Limited carried out work on 4 construction contracts during the financial year ended 30th April 2019. So it had 4 contracts. So we have contract price, cost to date, estimated total cost, payment on account. Now that payment account is the same as cash received. Then we have revenue recognized in previous years, cost recognized in previous periods, admin expenses, additional information. The company does not recognize profit until the contract is at least 5% complete. Then number 2, the company policy is to calculate percentage of completion on cost basis. The company prepares separate trading account for each contract. Required trading account for each of the contracts, showing clearly the revenue to be recognized in the year ended 30th April 2019. Now, trading account, that means the examiner wants to show you the revenue and the cost of sale to get the gross profit. Then number 2 is the income statement extract. Now the income statement now is you take the gross profit, you less other expenses. So for me, I'll just prepare it as just one statement. Yeah, and then number 3, extract of the statement of financial position. So before you prepare that, number 1, you have to estimate the percentage of completion, and we have contract A, contract B, contract C, and contract D. And how do we get that? So you take cost to date, you add estimated additional cost so that you get your total cost. Once you get your total cost, now you can be able to compute percentage of completion. Once you get the percentage of completion, now you can determine the amount of revenue recognized. So let's do that. We are given the cost to date. How much is the cost to date? How much is the cost to date? So cost to date for A, we had 180. B, we have 480. C, we have 963.6. And D, we have 840. Sorry, that 3.6. This is that 3.6. Then you also given the total cost. In this case, we're not given the additional cost. Rather, you are given the total cost. And the estimated total cost here we have is 720. Here we have it's 768. Here you have it's 1069.2. And here we have it's 840. So now with that, you can be able to estimate the percentage of completion. And you see that to get the percentage of completion, you take cost to date for example, this one will be, the 4A, you'll be taking 180, you divide by the total cost, which is 720 times 100. So it's 180, you divide by 720, and this one you get 25%. The other one you take 480 over 768, you get 62.5%. Then 963.6 divided by 1069.2, you get 90%, and this one you get 4%. So now with that, we can recognize our revenue. So how do we get the amount of revenue recognized? Revenue recognized, you take percentage of completion. For example, for you take 25%, you multiply by the contract price. Let's go to contract A. How much was the contract price? The contract price was 780. So you take 25% of 780, and you'll get 195. Then for B, you do the same, 0.625, and the contract price we have is 1,200. You have 750. For C, you take 0.9, you multiply by 1020, and you get 918. For D, you don't have to recognize. Why? Let's go to note number 1. The company does not recognize profit until the contract is at least 5% complete. Contract D is only 4% complete, so we cannot even recognize that. So with that, now let's present the income statement. So this was Mijengo Contractors Limited. Income statement extract for the year ended 30th of April 2019. So you only recognize contract A, B, and C. So let me take you back to the format of the income statement, and you take revenue recognized, then you raise cost to date. Once you get the cost to date, then that's how you get the gross profit to date. Now, up to that point, now that's what you call the trading account, up to where we have the gross profit. Then you factor other items, that's when you combine with the income statement. So once you get the gross profit to date, you raise gross profit already recognized. You see, this is a long-term construction contract. Maybe this project started some years back. So that means we have gross profit already recognized in previous periods, so that you can be able to get the gross profit for this specific period. So you get gross profit already recognized, so that now you get gross profit for the year. And then once you get the gross profit for the year, that's when you deduct other expenses. For example, you have admin expenses, and that's how you get the net profit. So let's do that. So we already have the revenue recognized. Revenue recognized for A was 195. For B was 750. And here we have 918. Then you raise the cost to date. And the cost already incurred to date for A is 180. For B is 480. And for C, it's 963.6. And that's how you get gross profit to date. And how much will be the gross profit to date? So here you'll have, this is 15. So this one will be 270. And here you have a negative 45.6. So up to that point, that's how you're presenting the trading account. That's part 1. But this profit, it includes gross profit already recognized. So you raise gross profit already recognized. So how do we get the gross profit already recognized? And note this, those are the separate contract. This one is not a one contract. They are separate contract. So you go back to the statement, to the question. Now, in the question, you are given revenue recognized in previous period. Then you're also given cost recognized in previous period. if you are given revenue recognized in previous period and you have the cost recognized in previous period, you can be able to determine the gross profit recognized in previous period. For example, for A, revenue recognized in previous period was 75. And the cost recognized in previous period was 16. So that means in previous period, they had already, 78, they had already recognized a gross profit of 18. You deduct that. For B, you'll be taking 180 minus 72, and 180 minus 72. So that's 180. Sorry, no, is it 180? Yes, 180 minus 72, you get 108. So they had already recognized 108. And then for C, you take 504, you deduct 480. That means they had already recognized 24. So you deduct that. And once you deduct that, now you're able to get the gross profit for the year. So this was loss. Then if you take so you have 69.6. That's a negative. And then for B, you take 270, you deduct 108, and you'll have 162. Good, that's how you get the gross profit for the year. Once you get the gross profit for the year, then you raise admin expenses. Already given for contractor, admin expenses was 1.5. The other one was 15. The other one was 2.5. So, and here you have 4.5 a negative. Then here you'll have, this is 147. And here you have 72.1 loss like that. Or alternatively, there is another format you can use. So you take the revenue recognized. Once you take the revenue recognized, you raise revenue recognized in the previous period. If you take revenue recognized, you raise revenue recognized in previous period, you'll get revenue for the period. Then you go to cost. You take cost to date. Once you get the cost to date, you raise cost already recognized in previous period. If you take cost to date, you raise the cost recognized in previous period, you're able to get the cost for the year. So that means to get the gross profit for the year, you'll take revenue for the year minus cost for the year. And then you raise that admin expenses. Last number 3, an extract of the statement of financial position. So let's present this statement of financial position. Mijengo Limited, sorry, Contractors Limited. Contractors Limited. Statement of financial position as at 30th of April 2019. So we have 3 contracts. We have A, B, C. So let's go to the requirement number 3. An extract of the statement of financial position showing the combined total asset for the 3 contracts. So you also have to show the total. And you say that the statement of financial position, you show 2 items, work in progress and the receivable. And how do we get the work in progress? You take cost to date, you add gross profit to date, and then you raise the amount of cash received to date. And that's how you get the amount of work in progress. Then to get the receivable, the payable, you take billings to date, but based on this question, we were not given the billings to date. So if you're not given the billing to date, you cannot determine the amount of account receivables. So in this case, we just require to get the work in progress. So how much is the cost to date? Now, cost to date, we have 180, we have 480, and we have 963.6. Then you add gross profit to date. That's from the income statement. And the gross profit to date, we had 15 to 70, 45.6 but a negative. Then you less what you received, cash received to date. So let's go back to the question. And cash received to date is the same as the payment on account. Contract A, you raise 156, you raise 780, and then we have 918. That's how we get the work in progress. So what do we have? So 195, you raise 156, you get that 9. 480 plus 270, you raise 780, and you get 30. 963.6 minus 45.6 minus 91, 918, sorry. Is that 0? 963.6 minus 45.6 minus 918. Yes, I'm getting a 0. So let's get the total. 180 plus 480 plus 963.6. So that means the total cost to date was 1623.6. 15 plus 270 minus 45.6. You get 239.4. 156 plus 780 plus 918. You get 1854. That one deduct, and you'll have 9. So that's how you're supposed to present that. So you can take a screenshot of that. So that marks the end of that session. So God willing, in our next session, so kindly go through, I want you to go through accounting for professional firms. Yeah, go through accounting for professional firms and something else. I decided what to do. But I'll not be doing maybe agriculture. This time I'll not do agriculture. So do accounting for professional firms. Thank you.